Twice a year, the Invesco S&P 500 Momentum ETF, or the SPMO, shuffles all of its holdings. We know this is semi-annually, and the latest September reconstitution is coming on the 29th. So this Friday is bringing some big changes to this ETF. Now, if you're like me, I do hold this ETF in my portfolio. It has had a massive growth over the last 5 years, right around 147% growth in the last 5 years. So I want to break down what is moving in, what is moving out, and really what is this momentum in 2025 that we're seeing. So in today's video, we're going to cover what the SPMO is, exactly how this reconstitution works, the winners and the losers that we're seeing, which of course, if you're someone who invests in individual stocks, you might want to keep aware because some of these stocks have moved out of the momentum that we see within the stock market itself, and also the reallocation risks, opportunities of investing in these ETFs. So what exactly is the SPMO and how does it work? It is, and it does track the S&P 500 Momentum Index. Now, if you're unfamiliar, this is roughly 100 stocks in the S&P 500, which has the strongest volatility adjusted momentum. That is exactly where this ETF gets its name, using and really the companies that are going to have, they're expected to have the most growth within the S&P 500. So you are still investing in these really big tech names, and it constitutes a rebalance twice a year. Like we said, it is the third Friday in March and September. So this is an active managed ETF. You have to know that, guys. This isn't something that just tracks the S&P 500. You actually have some very, very smart intelligence investors that are going in and rebalancing this on the Momentum 100, like we talked about, and really focusing on changing to make sure this is growing like it has in the past. Now, constitutions are weighted by both market cap and by momentum score. So there are a couple of valuations that they do use. Because of the methodology, portfolio can really have a meaningful rebalance, not just tweaking it, but there can be some massive changes, which is exactly what we're seeing. Now, some few facts to remember: it has a 0.13 expense ratio. Latest top holdings are including Broadcom, Nvidia, Meta, JP Morgan, Netflix, and a couple other ones. So it is all of these big names that are in the S&P 500. It has a very strong performance like we talked about historically, but of course there is volatility. When you start looking at some of these big tech names, these big tech companies, there of course can be a lot of volatility based on the news, based on the cycles, based on who's the president, even looking at tariffs, the volatility can be there. So now we think about the reconstitution. So what is changing? There are about 40 securities that are being removed and 41 added. So again, staying right about that 100 mark, roughly 34% of this portfolio by weight is going to be swapped out. So we're not changing all of it in its entirety, just 34%. New portfolio has 123 holdings, which of course, expanding beyond the 100 that was regularly reported, or some reports are showing there are 123 that are going to be included in this ETF when it comes to the reconstitution this Friday. So some of the big adds in here, when you think about the stocks over the last 6 months who have been doing incredibly well, Oracle is coming in, Visa, Cisco, Charles Schwab, and a couple other ones are going to be moving in. Now we're dropping out Amazon and Tesla. They feel like Tesla has already had its run for this year. Not going to see a lot more momentum, even though they are very high profile companies, accounting for a large portion of the weight. And that 34% that is being reconstitution, that is a big, big weight that is going to be lifted. Now, these are really bringing in some fresh and familiar themes within here. Big names, the weight shift and the momentum of this fund is changing a little bit. So sector size, what does it look like when we break it down outside of the companies itself into the individualized sectors? Consumer discretionary is dropping by 11%. This is because of Amazon and Tesla, both of them really big weighted within this ETF, making a big move right there. Technology exposure increased about 10% by driving names like Oracle. We know Oracle has been on absolute fire in the last couple months, and they feel like that momentum is going to carry and continue through the rest of 2025. And the diversification score decreased by 0.66, meaning a little bit more concentration to those 123 companies we see. But overall, one size, large cap still dominates over 50% of the portfolio. Even though it dropped a little bit, the fund has mostly and increased some exposure to the mid cap. So not only being in that S&P 500, but also picking up some of those really fast running mid cap companies that are out there. So, what do the signals mean? What is the changes as a financial advisor? What does the weigh in look at the insight? Really, the reconstitution reflects really the momentum and the rotation that we see with traditional companies. Names that had very strong performance might have again kind of hit somewhat of a peak, and you've been rewarded, and some that have underperformed or have even gotten dropped in here, or they feel like the momentum is starting to die out. They're dropping out of this portfolio. The portfolio being actively managed has to be very responsive to the changes in the market. Now, of course, by boosting tech and boosting and really trimming that discretionary, comes a little bit more concentration within the sector. Again, if you're looking for diversification, this is a lot more focused on the growth than we're seeing. So a little bit more risk on those certain sectors. And of course, dropping a little bit of diversification in there as well means that you could have a little bit more vulnerability when it comes to something like the tech sector. But then we look at the growth factor and, of course, the valuation. It favors high growth, high multiple stocks, a lot more sensitive with interest rates, which we know are coming down. That gives companies access to additional funds, where if you have corporate expenditures, if you have something that you really want and need to do for your company to help grow, money is going to be cheaper as the Fed continues to lower rates. And for those small caps, mid caps, even large cap companies, if you can borrow money at a cheaper rate for anything that you need to fund, you can do it again at that lower rate. But of course, earnings could be disappointing for some of these companies. And because the SPMO ignores valuation in its rules, it is really focused entirely and purely on recent price momentum. It carries a valuation risk like we've seen, which means as a growth part of the portfolio, 5, 10, 15% into a fund like this would make sense, because there are a lot of opportunities that are out there. And this is exactly the ETF that is going to be chasing them. So for investors who want that exposure to high momentum within the large cap US equities, it has the momentum slant which you want, having and carrying those big names which they think are going to make and really do those moves. It rotates out companies that are really not the cutting edge, or they've grown a little bit too big, meaning the next momentum wave is going to be moving in. Now, of course, the risk in what you have to consider, guys, turnover transaction costs, where if the rebalancing, this could mean there could be tax effects because they're selling out some of these companies. There's also a period where it could reverse sharply. We see this with any of the very big growth ETFs. If there is a down pull in the market, usually it's more effective. Overcrowding, momentum investing becoming more popular. The same, it can be true with a lot of the income generations that we see with our yield max ETFs and that we see with our NEO ETFs. It's kind of crazy out there how many ETFs are coming out and how many people are investing in this. Even right now, we have more ETFs than we have stocks in the stock market, which is kind of crazy. Now, in sideways or choppy market, it seems to underperform versus the S&P 500. But again, we're looking to get the growth out of here. So SPMO, definitely not a core ETF in there. Most people are having a buy and hold because, of course, it is kind of a satellite or a tactical allocation when it comes to the portfolio itself. Again, putting 5, 10, 15% in there. Also coupling this with something like the VOO or the SPY can really grow and have a balance of growth and stability in that portfolio. And of course, watching for these reconstitutions. The SCHD does the exact same thing. And I believe it is every March that we see the reconstitution. I know right now we had talked about it being a little bit heavy in a couple of sectors, and it seems like we're seeing that with a lot of these ETFs. So the September 2025 SPMO reconstitution, definitely cutting that 34% turnover, removing 40 companies, gaining 41, a little bit less in the consumer discretionary, more in tech, slight mid-cap increase in there as well, meaning we're going to continue to gain momentum, use in really, it's a tactical tilt towards the growth that we see. Now, of course, as we do with all of our videos, guys, if you found the content really helpful, insightful, let me know in the comments. Like the video so it goes out to more people. Subscribe to the channel so we know exactly what you're doing. Now, this is, of course, educational, not individual investment advice. You have to do that on your own. If you're working with a financial advisor or doing your own research, absolutely do your research before you're investing in anything. And thank you guys for watching, and I'll catch you in the next video.